What's going on, guys? This is the Snowball Experiment episode 15 already. This is the series in which I show you what I would do if I started over with the knowledge that I have today in order to build wealth through dividends and covered calls. This is a little experiment that I wanted to create to inspire some friends to start investing periodically on a regular basis and diversify properly. And none of this is financial advice, of course. This is just me sharing some of my experience and my opinions on the matter. For today's topic, we're going to discuss cyclical stocks specifically and how I basically find these opportunities and how I get out of them and why. So I hesitated a lot to be honest with you before sharing this because this, I think, requires quite a lot of experience and some patience and a bit of knowledge of the different sectors and how they move and things of that nature. So it's not for everybody, but since the best performing stock of the snowball experiment is the cyclical stocks, I wanted to show you how I found it in the first place. Today we're going to take a look at 5 stocks specifically that I've actually bought and sold in some cases already. I don't recommend that you buy or sell these stocks based on what you're going to see today because it's already late. But I wanted to show you what happened in the past. And these are some cherry-picked examples. There's a lot of those that haven't worked. And it's just a numbers game basically because my risk reward ratio is so high then I can have a few duds in there and I still make a huge profit at the end of the year. And this is the way that I usually beat the market, the S&P 500 as a benchmark. It's because I put a certain percentage of my portfolio towards these cyclical stocks that eventually pop and give me a huge headwind. Exhibit A is going to be ODOI. The way I found that stock, I bought in that zone over here. And the way I found it is because I had traced these lines. These are the original lines. I haven't moved anything. And basically, I bought it in that zone over here, and it pumped 500%, and I exited in that zone here. I had put a target of $30.52 when I drew it, but I did not exit at that point. I exited slightly before that. And just to show you, these are the points at which I bought. So I bought a bit at 561 and I bought a bit more at 489. And then I sold in that high of 24 and then here 25 and 30 cents. So around 25 bucks. So I bought for around 5 and sold for 25 for 500% profit. And all I did was basically I drew supports and resistances, and then the orange line is basically my 50% line at which I think that there's going to be some type of resistance, meaning that the stock has a hard time going higher than that. Sometimes it just goes through it like butter, but that was the original idea of that trade. Exhibit B is QUBT, Quantum Computing Incorporated. I purchased that one at 78 cents and I exited way too early on that one, I remember. But it went on to do a 3,300% run, so that's quite a bit of money. If you put 1,000, you end up with 33,000. So that would have been a nice one, but I've exited earlier, as you can see here. Um, I kind of freaked out. It was too much profit too fast, basically. So I exited. I had multiple positions that I exited in that zone here in the $6-7 area, and not long after that, it went on to the $18 price target. I haven't touched it since. It's been coming down quite a bit. but to me, the trade is basically done. What I was trading this off is a pattern that I really like. It's like a coiled spring, um, where you have a triangle that goes down, and then eventually there's a pattern that I call the snap. This is not something I've taught in book. It's just something that I've noticed over time. And basically, the price goes out of the pattern and then gets rejected and then starts to accumulate back towards the upside. And I can show you a few examples of this. The same thing happened with Next Era Energy a few years back. I'm sorry, the stock was Next Gen Energy, not Next Era. But basically, this is what I drew several years ago. It did a snap over here, came back inside, and then I started to purchase on the coming back of the price within the pattern, and then on the break as well. Once it broke out of that long pattern descending triangle, basically. I bought some more and I had posted this, and then the rest is history basically. Um, so today it's trading at $15. Exhibit C is Dow Inc. It is a chemicals stock which is very, very cyclical. And I drew this a while back as a point of support where I would start purchasing some stocks. And then my goal was to sell some of the 50% range with it has reached, and then some more at the upper level. But I haven't sold yet. In fact, I'm gonna hold this for a little while until it reaches the beginning of the red zone. I think this is gonna go still up for a while, and it had a good dividend around 6% at the time that I purchased it. So my yield on cost is quite high for that stock. So as you can see, I purchased twice at $21 or so, and it's been up 60 something percent. I've seen it at 84%, I think, before the current retracement. Uh, Total return, so I mean capital return, not including the dividends. So that's a very, very good position for me to have. Another stock which is very close to Dow is Lyondell Basel Industries. This one I had planned on buying at several levels and just cost average my entry and have the dividend coming in while waiting for price to go back up. At the time of me purchasing this, it had a 12% dividend. Um, Now it's I think it's a bit lower. Basically at 3.73. So the dividend has been cut and the price has been going up. And I purchased this on 3 occasions in different accounts because I thought strongly about the stock, mostly because it hit the one of the zones which was a historical support, and then volume started to increase gradually. And when volume increases, it tells you that there's a lot of money changing hands, and it's a point that might be a turning point, and that's why I went pretty big on that one. Last but not least is SWBI, Smith& and Wesson Brands. These guys sell guns, and this is a like a 20-year pattern, a channel that has been going on for a long time. And as you can see there's been moves of 3,000% followed by 93% decline, and then 400%, minus 70, 1,200%, minus 82, and then 800%, minus 79%. And now I'm going for the home run for this one. I'm going to hold this for several years, most likely. I purchased this at $9, basically, so right along that support. It had at the time it was at 5 point something percent dividend. So I'm just gonna hold it. It pays me to be patient, basically. And in the current international climate that we have right now, I thought it would be a good idea to have this type of cyclical stock, which is related to weapons. So, and that's been the stock that performed the best. If we look at total profits here, Smith and Wesson is up 64% in the snowball experiment. The other ones were into different accounts, but this one I had was one of the first purchases that I made in the before I even started doing the videos. So that's what it looks like right now. Silver has been the second best. Northland Power is doing really well with 28% in 6 months. Brookfield Renewable Partners at 23%. Gold, I did some profit taking, so that's why it's showing this. HHIC 20%. So these are the best performing ones. The worst performing ones so far are the Novo Nordisk bets. I had purchased a covered call on it and the original stock in Canadian dollars. But I plan on adding to this. I believe it's going to turn around eventually. Blocks has been quite a bad investment. I think I bought exactly the top or something like that. It was really bad, but it was not a big position anyway, so it doesn't matter. I can always cost average since this is a non-leveraged long-term position. Coinbase down as well. Biggie. The defensive stocks like Hormel, GIS, Conagra, these I believe that when they turn, they're all going to turn at the same time. So I'm just going to be patient and probably purchase more as time goes on. So far in the experiment, the account is up to $12,000, 800 bucks in profits. Returns around 20% if annualized so far, so that's quite good, with passive income of 18%. So that tells me that I can maintain my NAV, my net asset value, quite flat while taking out the dividends, which is kind of my goal. What I want to do is to sort of create a bond that will give me a yield year after year or month after month, and while staying relatively stable. Right now, I'm doing a strategy that I'll explain into the next videos. But I expect the income, the passive income to go up, but the NAV to be a bit more volatile. And then as the annual returns or dividends or distributions come in, I will redistribute towards more stable assets as the account grows. So that's what I wanted to share with you guys today. This is what it looks like in the past 6 months. We've been growing and growing, and it's just going to keep on trucking in the next few months as well. I'll do less videos, maybe every month or two, because you guys kind of get the point, and I'll explain how I'm rebalancing the portfolio or directing money towards sectors that I believe are a bit more attractive to me. And then you guys can make your own decisions past that. So I'll see you in the next video. Thanks for watching.